back in mid-January, okay, we started to see a major rotation out of equities into bonds. Okay, that was a big clue. Um, but let's talk about contango and backwardation. This to me is probably one of the most powerful methods for identifying market chaos if there's going to be a major market sell-off and when markets are likely to rebound. So where's the bottom? So we look at VIX or volatility futures, VX, okay, and specifically, and we this is something we talk about occasionally, is we look at um, whether we're in contango or backwardation. And so, what does that mean? So contango is an upward sloping futures curve. So what you'll see is the front month, these are the contracts here. Okay, this is our active contract, the March contract. Okay, so what you'll see the vast majority of the time is the front month contract priced lower, and then as you go out to these back month contracts, you'll see the price increase. I'm just looking at the price here. Okay, so that's contango. That's what we're normally in, where longer dated futures contracts are priced higher than the spot price of the VIX or the VX. However, backwardation is a downward sloping futures curve. It's a major bearish signal, okay? And we got it yesterday. So if you're not using this, you should be, and it would have if hopefully you weren't, but if you were one of the, I'm sure many traders who got trapped in that Friday bullish reversal, thinking that was the bottom and we were going to start moving back up, the futures told a different story. This alone could have kept you out of that trap because we went into backwardation. And that means that, again, we have a downward sloping futures curve. Um, and the front month contract, or the active contract, which again is March, the March contracts, is priced higher than the back month contracts, April, May. Okay. And generally, we'll just look at the next monthly contract, so April. This spread was much wider yesterday. Okay, the March contracts were priced above 21. It's tightened up a bit, but you can see that the March contracts are priced at 2070, while the April contracts are priced at 2035. So we are in backwardation, and that can be a great sell signal on its own. But it's not going to stay that way. Okay, eventually we'll go back into contango, and so what this is telling us is that the market is, and the reason we're using volatility futures is because that's the market's fear gauge, right? When markets sell off, volatility increases. When we're in relatively stable market conditions and we're that could be a bull market, an upward sloping trend, we'll be in contango, and you'll see the active month contracts priced lower than the back month contract. So in terms of using it as a tool to identify market tops and bottoms, right? When we're in contango and we go into backwardation, things can get really ugly really fast. We can get big sellouts like we did yesterday and today. Okay, this gave us that forewarning. But then also pay attention to the spread between the March and the April contract. Okay, we are starting to kind of see that tighten up, but we still are in backwardation with the March contracts priced higher than the April contracts. So you want to watch the spread and the trend of that spread closely. Because again, backwardation, it typically doesn't last very long. So what you'll want to look for here is for the price of the March volatility contracts to drop back below the April contracts. So because what this is telling us is that the expectation is for a market volatility in market sell-off like now, like immediately. Okay. Obviously, the further you go out in time, the more time you give yourself, the more uncertainty there is. And that's why when you're in contango, you'll see the further dated contracts priced higher. Okay. But even the April contract is priced higher than the May contract. And the May contract is priced higher than the June contract. Okay. Um, it's not until July where we have a higher price on those contracts than the earlier month contracts. So what you want to watch for here is for the current active month contract to then drop back below the price of the next month contract, in this case, the April contracts. That can be often a good indicator. It's not a matter of picking an exact price bottom. It's a matter of identifying the likely area of where the markets are most likely to reverse back to the upside. And we're not there yet. We're still in backwardation. But watch closely. Because this is, I think, one of the most reliable tools for identifying uh, if we're likely to go into an official technical correction, which is a peak to trough of 10% or greater, um, and where markets are likely to reverse back to the upside when we transition back into contango from backwardation.